Our next guest says the risk reward is in fact improving. Not enough, though, to play offense just yet. Let's bring in Keith Lerner, co-CIO and chief market strategist at Truist Wealth. Welcome. Why not yet? What are we waiting for?
Oh, great to be back with you, Scott. So we put out a note last week during the correction that said we saw the move down as a healthy reset. So our advice to our clients last week was, if you're underweight equities, use that as an opportunity to increase equities towards targets. Markets went from the most overbought we've seen this year to the most oversold since March. The good news is it's responding, right? You want to see if you get an oversold condition, does it respond? And we're seeing that. At the same time, we've seen valuations come in, still far from cheap, but we're seeing earning trends or forward earning estimates at a 52-week high. And so altogether, I think that's positive, Scott. But I still think there's some challenges that lay ahead. I just think that things got overdone, and as far as the overall market, you have to respect the underlying trend is still somewhat higher. So that's how we're looking at things today.
I mean, there was a point, I don't know, a couple weeks ago where it felt like the trend was broken and that we were going lower. Now that the market's back up, now here we're hearing, these calls that, well, the trend's still up. I mean, it was a different story not 2 weeks ago.
Yeah, well, if we looked at our note from last week when the market was going down, we actually said that was an opportunity. And our title was, this is a healthy reset. Because, what happened coming into August is you had high expectations, right? The economy this year has surprised to the upside. Earnings have surprised to the upside. And inflation has been better than expected. So what you saw is a lot of optimism come into the market, which you're bringing up. And the bar for positive surprises became too high. That's why August has been somewhat challenging. But in 2 weeks, before this rally that we're seeing the last couple of days, we saw all of that reset, again, a healthy reset, and that's why we think things are, overall fine. I still think it's going to be a choppy move forward, but in a higher range. And then when you're thinking about equities overall, there's still relative opportunities. We're still seeing communication services today looking at a new, fresh relative high to the overall market. You're seeing discretionary act somewhat better. So, there's still opportunities. One other thing, Scott, outside of the equity market, I know that's where we tend to focus a lot. Just this week within our fixed income portfolio, we added to longer term bonds as yields got to 4 1/4.
Of all the things that have surprised to the upside, which you mentioned, the other thing, and maybe the most important thing, and why the market had a bit of an issue, rates, right? Rates surprised to the upside. Maybe not so much in moving up, but in the magnitude and speed in which they did. And that was upsetting to the market for a bit.
That's right. And I think just having some stability. And today, the big part of the rally today, we have that JOLTS number that comes in weaker than expected. Consumer confidence a little bit weaker. But the market's looking at that as, hey, the Fed could ease off a bit. And the 10 years coming down. Look at the 2-year Treasury, the most sensitive rate to the Fed funds futures. And you're seeing that come down double digits today. So I think that's why we're seeing this overall rally as well. But again, I mean, the picture right now is, I think, modestly positive. We have inflation that's come down somewhat. Valuations corrected a little bit, sentiments come in, and from a technical basis, what you're seeing across the S&P and technology stocks and the Nasdaq is you're breaking above the 50-day moving average, so that's widely looked at. And I do think we make a run at least closer to that 4,600 level, which was where we peaked out a few weeks ago.